Good evening, everybody. Thanks for joining us tonight. Brittany Piquel, representing Next Generation, and I have on the phone with us Alina Trigup from Samo Financial as well. As you know, we're going to be talking about using self-directed IRAs to invest in commercial real estate syndication. So we're going to cover the concepts of self-directed IRAs for those of you that might not be as familiar, and then Alina is going to share her expertise with us related to real estate investing and specifically syndications and how that could work potentially with an IRA. So before we get started, I just wanted to let everybody know that we are going to record the session. So if for some reason you have to drop off early or you know somebody that registered but couldn't attend, we're going to be providing a copy of this recording to everybody via email. So after the session, probably later on tonight, you'll get an email with a link to that. So you can reference it, you can send it to anybody that you know if you think it would be valuable. The other thing that we wanted to mention is that we're going to hold questions for the end of this, and we're going to leave at least 10 to 15 minutes, but if you do have questions, please enter them into the chat box or the question pane on the right side of your screen on that control panel that you see. And we'll be happy to field them. But we also wanted to let you know that we did look at the information that you submitted when you registered to let us know what you wanted to learn. So we tried to make sure that we incorporated those topics into the presentation tonight so that we could address the things that you expected to get out of it. And if for some reason, once we get toward the end, you feel that we didn't address your question, please, again, pose it, and we will make sure that we try to answer what we can for you. So let's jump into it. I know everybody's probably had a long day and it's Thursday night. Just really quick, as far as self-directed IRAs and the role that Next Generation plays, we're not a bank or a financial planning service, but we are custodians and administrators for self-directed IRAs. So whether or not you know what a self-directed IRA is, you probably know what an IRA is. And any IRA has to have a custodian, which is typically a financial institution that can hold the account, hold the plan, right? And it's a retirement plan, and can hold title to the assets within those plans and provide reporting and other types of customer service related to it. So our specialization is specific to self-directed IRAs, which we'll talk about in a minute. But again, we offer the financial services. We're not advisors, though. Our primary goal is to service the account and to offer educational resources like we're doing tonight so that investors can, learn as much as possible to maximize the returns within these types of investments. So I'm going to talk really quick about a little bit of background related to the company, just so you understand our skills and kind of where we came from. So Jamie Raskolnik is the CEO and founder. She founded the company in 2004 because she was a real estate investor and she wanted to make real estate investments within her own IRA, but she couldn't find a company that would help her to do that. So she began as a part of a national network of administrators of self-directed retirement plans, which are those plans that allow her to do what she was looking for. And then she led that from startup to over 150 million in holdings in 5 years. And then after that, she decided to break away from the network and she started her own firm. So that's how Next Generation came to be. And to date, we hold over 600 million in assets, and we have about 2,000 accounts that we manage for clients. And then in July of 2017, we became a trust company. So that afforded us the ability to act as custodian and administrator for these accounts. So the trust company I'll talk about in a second is located in South Dakota, licensed in South Dakota. And then Next Generation Services is a customer service arm in New Jersey. So Jamie actually has been a longtime real estate investor herself. She's worked full-time in the real estate industry since 1994. She's a certified property manager, a licensed real estate broker in New Jersey, and she's been involved in a lot of statewide real estate organizations. So she's just very involved in real estate investing and knows a lot about real estate. So obviously this is a big area in terms of self-directed IRAs and in terms of the assets that a lot of these IRAs invest into. So in order to make an investment in alternative assets with a retirement plan, you need these two components. You need to have a custodian and you need to have an administrator. So some administrators rely on an outside custodian to hold assets that aren't within their own organization. But as you can see, we have everything under the Next Generation umbrella since the formation of the trust company, which basically holds title to clients' assets, is a regulated financial institution, and then provides the tax reporting for these plans. And then the services arm, which is the administrator, is going to be, the people that you speak to if you're calling in to talk about your account. You're getting all the customer service and account management from that department. And then they're also going to be the people that review investments for compliance with IRS guidelines and then process those transactions for you. So just a quick disclaimer, because we are a neutral third party and we're just a custodian, we don't offer investment advice or approve of investments. So this is a little bit different than having a brokerage account where you might have an advisor that's telling you how to allocate your portfolio. In this scenario, we're not a fiduciary, so you have complete control over your plan here. You have complete control over what you decide to invest in. No one's going to restrict you from investing in anything unless it's outside of IRS guidelines. And the information that we provide is educational. So our goal is to give you all the information that you need to make the best decisions that you can and to try to maximize the return within your accounts. So what is a self-directed IRA? And just to take a step back, why should you care about IRAs or self-directed IRAs? So obviously retirement is something that matters to everybody that's listening and everybody in this country. And we're starting to see a shift in the landscape when it comes to retirement. So, we're seeing that there's an increase that investment advisors are looking to increase exposure to alternative assets, for one, in their clients' plans. And they're looking at things like real estate and private equity and lending, aside from just typical stocks and bonds. But the other thing that's really important to understand is that more and more older Americans are filing for bankruptcy protection, and it's really alarming. So a recent report in a recent article in the New York Times said that the number of 65 to 74-year-olds seeking relief and looking for bankruptcy protection has tripled over the last 2 decades. So that's pretty alarming. And to try to understand what that means is, maybe we're talking about, unmanageable medical expenses, gaps in coverage from Medicare, drops in income because, pensions aren't really common anymore. We're seeing a shift from pensions to 401ks, rising debt, things like that. And to really save for retirement and to do it effectively, we need to look at all the avenues, and we need to not just rely on pensions anymore because they're either not going to be there or Social Security is not going to be enough. So we need to start looking at ways to expand, and self-directed IRAs are just one way to do that. It's not to say that you should just take all your money out of a brokerage account and put it into a self-directed IRA, but it's a way to diversify your portfolio because it allows you to invest in non-traditional assets. So these are things that are not not part of the stock market. They're not subject to the same type of volatility that you're going to see when you're invested in stocks and bonds. And so if you have skill in a particular area like real estate, you're able to put your retirement funds into that and have more control over the decisions you're making, and hopefully ultimately more control over the return you're getting. And the nice thing about the return you're getting when you're using a self-directed IRA is that those investment earnings are tax protected. So they're held within a qualified retirement plan. So if you have a tax deferred account, they're going to be tax deferred earnings. Or if you have a Roth, they're going to be tax-free earnings. So it's really opening up the number of allowable investments, and it's giving you a way to diversify your retirement portfolio. So types of plans that can be self-directed, you can see all the types here. Someone did mention that they wanted to understand solo 401ks a little bit better. So just real quick, most people that are opening accounts for self-directed investments are establishing traditional tax-deferred or Roth IRAs. SEPs and Simples are for self-employed individuals because they allow you to contribute more out of pocket to your account on an annual basis. But the solo 401ks are typically for self-employed people who want to establish a 401k plan for their business, or they already might have one. And what that allows you to do is contribute more on less income if you are a business owner and you're willing to establish a 401k plan for your business. So the assets can also be vested in the name of your plan. And one of the benefits of using a solo 401k plan to do these types of investments is that certain taxes that might apply to a retirement plan are not applicable in this case. And we'll talk about that a little bit later. That's not to say that everyone needs to open a solo 401k, but I just wanted to make sure that I touched on it because I know that there was some interest expressed when people signed up that they wanted to learn more about it. So we can talk about it a little bit further in this session, and then if there are additional questions afterward, I'm happy to discuss it further with anybody who's interested. And then you'll see the last two account types on here are not really common. So Coverdell's, they're education savings accounts, and they're primarily meant to save for a child's education expenses. You can actually establish one of those accounts as long as you have a child that's alive. So even if they're a baby, you can set up an account for them, and you can be responsible for directing the money in that account to make investments to grow that account, and then those funds can be withdrawn tax-free for their education expenses, and that's any education up to college. And as long as you're using those funds by the time they turn 30, you can use them tax-free. So it's a pretty nice vehicle to be aware of if you have a young child and you want to use, an account, a qualified plan to help contribute to their education expenses, which we know are growing. And then obviously health savings accounts, very common for medical expenses. We're seeing more and more of that as well, but a lot of people don't realize that they can actually use an HSA to make their own investment decisions and invest in alternative assets. Because I think that a lot of people tend to use those as kind of like bank accounts for their out-of-pocket medical expenses, and they just park the money and it just sits there. But you can actually take that money that you're contributing to the HSA and invest it into things. So if you want to grow the value of that over your lifetime, you can really grow that type of pool for medical expenses, and that could really have a positive impact on your ability to pay for medical expenses later in life as well. So as far as options for funding an account, you can personally contribute. You can basically write a check with your own personal funds to your account, but you have to remember that the IRS sets annual contribution limits for these, and it depends on the type of IRA or account that you have. That information is on our website, and it's also on the IRS's website, so you can always check that, or you can call our office to ask. But most commonly what people are going to do to fund a self-directed IRA once they've established it is they're going to transfer funds from another IRA that they have, or they're going to roll over from another employer plan that they have. Typically, if you're rolling over for your 401k or other type of plan, it could be like a 403b or 457, depending on if you work for the government or if you're a teacher. Those plans you can roll into a self-directed IRA, but they have to be eligible to roll over. So typically you're no longer working for the employer in order to do that. But it's always best practice to just contact the administrator of your 401k and ask if it can be rolled over. And then if it can be, we're happy to take those funds and deposit them into your self-directed IRA so that you can start making alternative investments. And then someone actually asked about distributions from accounts as it relates to penalties and taxes. So with a tax-deferred account, obviously the money that's going into it isn't taxed. So if you have a traditional IRA or a SEP IRA, or just a regular 401k that you're self-directing, those funds aren't taxed until you withdraw them later. So At the age of 59 and a half or older, you are not subject to the 10% penalty. So if you wait until you're 59 and a half to take funds out of your retirement account, you will not have to pay a 10% penalty. If it's a tax-deferred account, when you're making those withdrawals at that age, they're going to be taxed at that time based on the income bracket that you fall into. If you have a Roth account, you can withdraw those funds after age 59 and a half with no tax because you've already paid the taxes on the money that goes into a Roth account. So it's just important to understand the differences there. And also, someone asked about, which I think is a really good question, required minimum distributions with these types of accounts. If you have a tax-deferred retirement plan, the IRS requires you, if you haven't taken withdrawals by the age of 70 and a half, you're now required to start taking withdrawals by 70 and a half. And that amount of withdrawal that's required is calculated based on a number of things, including life expectancy. But the question becomes with a self-directed IRA, for example, if I'm invested in an alternative asset, it's not a liquid asset typically, right? Because we're talking about things like real estate. So how do I take my required minimum distribution out of an IRA that doesn't have liquid assets? So the answer to that would be, one, you could, if you have cash in that self-directed IRA, take the required minimum distribution from the cash that you have. But most often what you're going to see is that people are going to look at other IRAs they have to take their required minimum distribution. So whatever that calculated number is an aggregate across all your IRAs. So you're able to look at the other IRAs that you have, which could be a brokerage account, for example, that might be invested in stocks and bonds, and it's much easier to liquidate those assets than it would be to liquidate an alternative asset or privately held asset. So it's not something to necessarily be concerned about, because if you're diversified enough, you're able to pull from your other IRA or IRAs to take that required minimum distribution. So it's not necessary that you take it out of a self-directed IRA. So I just wanted to make sure I noted that, because I know there were questions that came from certain individuals. So I'm going to move along a little quicker here. With the self-directed IRA, possible investments include things like we are going to cover tonight: real estate, mortgage notes, tax liens, private equity, limited partnerships. There's so much that you can do with these types of accounts that you can't do with a brokerage account. And the only limitations are basically what you see here. So life insurance and collectibles and antiques. The IRS basically, dictates these are the only things you can invest in with a self-directed retirement plan. So if you're interested, and obviously we're going to cover real estate tonight specifically, different ways you can use the IRA to purchase real estate. You can purchase property directly in the name of the IRA, which would be on the deed, and it would be listed as the investor and the owner of the property. You can purchase it via an IRA LLC, which is basically an LLC that you'd set up that would be funded and owned by your IRA, that you would have checkbook control over. You can also invest into mortgage. You can actually invest in mortgage loans, and you can also loan to real estate companies or real estate investors who are going to do their own project and they're just looking for funding. So you can use your IRA to act as a lender, and then you can collect interest, principal, and potentially some profits on sale of a property. Or you could also just do a private placement and invest into an existing entity or another privately held fund that's investing in real estate. Just keep in mind that all your investment returns flow back into your retirement plan, which enables you to keep the tax advantage status of those investments. So I'm going to talk about some of the things you can't do now, which might not make everybody happy, but it's important to know and important to understand prohibited transactions, which are defined in the Internal Revenue Code. So disqualified persons are basically people that are identified as not being able to transact or invest directly with your self-directed retirement plan. So the first person on there is the IRA holder, which would basically be you personally. your spouse, your ascendants, descendants, and their spouses, fiduciaries of the account, which would be, for example, a financial advisor, any entities that are majority owned by disqualified persons. So an example of that would be like an LLC that you own. You wouldn't be able to use your IRA to invest with an LLC that you own directly, or an LLC that might even be owned like 25% by you and 25% by a spouse. If you have majority ownership, you wouldn't be able to use that entity to invest. And then other business partners and people providing service to the account. So it's just important to ask yourself, these questions when you're thinking about doing an investment with a self-directed account, and then asking yourself, who am I looking to invest with? Who's benefiting from the investment? Make sure that it's not these people, and that the investment is for, the benefit of the retirement plan. And then, you should be on the right track if you're looking at it that way. So just really quick, as far as types of prohibited transactions, there are 3 types. You can see you basically don't want to directly engage in a transaction with a disqualified person, which would be buying from them, selling something to them, or loaning to or from. You can't personally guarantee a loan if your IRA takes a loan. So that's important to understand. If you're investing in real estate and you need additional financing or a mortgage, it would have to be a non-recourse loan, because you cannot extend credit beyond your IRA to yourself or any other person that's disqualified, as we just looked over. And then self-dealing, which is more of a gray area, but important to understand. If you think anything might present a conflict of interest in your mind, or you feel like the investment you're looking at with your IRA might be double benefiting your IRA and then yourself personally, or somebody else personally in the short term, that's considered self-dealing. So an example would be if you used your IRA to invest into a private company, or an LLC, and you were also paying yourself compensation for providing services to that LLC. Your IRA is benefiting, but you're also personally gaining short-term financial benefit. The IRS basically does not allow that with self-directed plans. So it's important to know that this is significant, because if you commit a prohibited transaction and it can't be corrected, then the IRA ceases to be an IRA. It loses its tax advantage status. Funds are distributed to the IRA owner personally, and then the penalties and taxes apply, and potentially back taxes if the transaction took place in prior years. So you just want to make sure that you're knowledgeable on the regulations, that you understand what you can and can't do, that really this is in the best interest of your retirement plan, because you care about your financial future and you want to try to do the right thing for yourself, so that when you get to that age and you're able to retire, you have a good life for yourself. So, those things are important, and that's kind of what we're here for as well. So our job is to provide education on these things and beyond what I'm going to talk to you about tonight. So if you have an account with a custodian or administrator, you should feel comfortable being able to call them anytime when you're thinking about doing a specific investment, to ask them, is this okay? Is this something I can do? Do I need to consult other resources to determine if this is okay? And they should be able to guide you in the right direction. So with that, I'm going to turn it over to Alina to talk about the real estate end of this more specifically, and then we're going to come back later on to the IRA discussion, because I think it'll make more sense once we've spoken with Alina a little bit, for you to understand how you can potentially then start using an IRA to do these types of investments. So Alina, I am going to give you control of the screen, and whenever you're ready, you can take us through.
Thank you, Brittany.
Perfect.
Can you see my screen?
Yes. Yep. Perfect.
Excellent. Hello, everyone. My name is Alina Trigup with Samo Financial. I'm very honored to present to our audience today, and I hope that my presentation will prompt our listeners to further explore the topics that I'm about to present. Let's dive right in. The agenda for today's presentation includes a brief synopsis about the entity that I represent, the rule of thumb gauge for a great investment strategy, a few words about the basics of syndication and why multifamily real estate investments are beneficial, a short reminder why we should all include passive income in our portfolios, followed by a brief list of ways to mitigate investment risks. Now, allow me to brag a little about our organization. SAMO Financial is part of a large network of like-minded investment companies, which allows us to pool the resources and invest together in prospectively valuable assets. There's a lot of work that goes into our expertise, but when you boil it down, basically we help investors to pool their funds together in order to purchase a property that's more expensive than any of them could have afforded on their own. More importantly, our job is to make sure that the syndication deal provides a good return to investors, and the next slide unpacks how exactly we do our job. We evaluate and research the markets where we invest prior to even locating properties there. We perform due diligence on each and every property before making an offer, including a very detailed underwriting. We don't hard sell. Instead, we use an advanced questionnaire when we meet with our new prospective investors to determine whether there is a fit, and we continue to individually work with each of them to understand their needs and to communicate what we can offer them if we partner on any future opportunities. Our investment philosophy is also about improving and beautifying the properties, and we offer our investors to make a positive impact on the communities together with us. Allow me to spend a few minutes on our criteria for investing in a specific location. Take, for instance, Dallas-Fort Worth, Texas. While it's still considered a relatively inexpensive market, it is a fast-growing and has been increasingly valuable for many reasons. Look at the spectrum of available job providers: Advanced PCS, Dean Foods, ExxonMobil, Kimberly-Clark, Newman Marcus, Southwest Airlines, and Texas Instruments, to name a few. It boasts some of the best large universities, such as University of Texas at Arlington, with over 10,500 graduates, University of North Texas, with over 8,600 graduates, and Tarrant County College District, with over 7,800 graduates. The job market makes it consistently one of the strongest in the nation, and it continues to have one of the highest job growth rates in the U.S. Dallas-Fort Worth Metro is over 7 million. The Dallas-Fort Worth Arlington metropolitan area, 146,000 resident jump in 2017, was the most of any metro area in the United States. Dallas-Fort Worth also offers one of the most developed highway and public transportation systems, as well as the international airport. Bottom line, it is a large metro area with everything to offer. Next, let's spend a moment on a simple description of what makes it so enticing to invest in a commercial real estate. Let's take, for instance, self-storage. The basic income is acquired from each tenant when they pay for a rented storage unit. On the top of the basic income, there is also an art to also use value-add strategy by offering additional resources and services. For example, if a tenant needs a moving truck to move their things into a storage unit, we would offer it as well. I will expand on the value-add strategies on the next slide. Our expenses are nothing out of extraordinary. They include such typical things as electric, common ground maintenance, mortgage, and insurance. What always left is the NOI, the net operating income. But when the time comes, investors also benefit from the sale of the asset because the equity, as well as the proceeds from the sale, are distributed back to investors. As I mentioned in the previous slide, the art of the deal is to maximize profits, and that's the point of using value-add strategy. It is done where increasing income or decreasing expenses, or doing both at the same time. So it comes down to basically invoking various ways to use the existing asset to make more money for the investors. Some of the strategies will seem simplistic, but you will be amazed how much more income they can guarantee. Right off the bat, you will notice that the previous landlord's mistakes are our gains. Firstly, property management must take both workers and tenants' needs into account. Basically, folks should want to work and rent in a development. As investors, we want to improve tenants' living conditions so that we can charge higher rent. Other value-add strategy is to simply adjust rents to reflect nearby rates, or to deflect expenses, such as having tenants pay for their water usage, or to charge for covered parking in a hotter climate geographies, for instance. When someone wants to buy large commercial property, it requires a lot of money, even for a down payment. One of the ways to solve the issue of covering this large down payment is to have a group of investors pool the money together in order to purchase large commercial real estate. This pool of people is grouped together into syndication, which buy investments via partnership. The best example that I could think of is an airplane. The pilots in an airplane would be the GPs, or the general partners in the syndication. And the passengers would be the LPs, or limited partners. So just like in a partnership, the GPs do all the navigation and flying, and the LPs invest in a seat and let the GPs make the decision. The main roles within syndications are presented on this page. I won't read them off to you, but I do want to take a few minutes to say that syndications are regulated by Security and Exchange Commission, by SEC. As such, there are extremely specific guidelines as to who can invest in a syndication. Hence, in some cases, in order to be eligible to participate in some of the syndication investments, an investor must be accredited. A definition of accredited investor is someone who makes $200,000 a year for the last 2 years if they're single, or $300,000 a year if they're married, or they have a net worth over $1 million excluding their home. In other instances, depending on the ruling utilized for a particular investment in a syndication, sophisticated investors are also allowed to be part of it. The definition of sophisticated investors is slightly different, as it does not have any financial prerequisites. Rather, these people must have basic financial and investing knowledge to understand what they're doing. Feel free to ask me any additional questions or about additional details after the presentation. Let me list some of the benefits of investing in multifamily real estate. It is an additional stream of income. It allows to diversify your portfolio. You receive true passive income, as if you come to think of it, there is literally very minimal work involved from a limited partner perspective. You build your family wealth. You receive quarterly or monthly dividends delivered to you without any headache. You help to improve the communities, and you're on the winning side of the generational shift. Just to elaborate, when I say multifamily, it really entails other types of commercial real estate as well. Again, here is another way to present the benefits of commercial real estate investments, as they're unmistakable. And once more, just to bring home the fact that real estate syndications allow investors to benefit from the most, here's a comparison with REITs, or real estate investment trusts. When you buy into REIT, you own shares of fund. When you buy into syndication, you're a partial property owner. Syndication fees are lower than that of REIT. Dividends paid in REITs are treated as ordinary income. When a property is purchased, through syndication, the depreciation taken against the property helps to lower the actual income received with dividends in the first few years. Hence, the taxable income may be lower than the actual income received during the year. Commercial real estate investments are much less volatile than the stock market. The investors that invest in REIT don't have any control as to what goes inside the REIT. When investing in a syndication, the investors know exactly what property they're investing in. And there is very limited transparency as to what's going on in the REIT. Syndication investors receive periodic updates that detail what's going on with the property. From our point of view, now is the best time to invest in the commercial real estate. Let me unpack the reasons again. I'm not going to read them, but I do want to stress that both baby boomers, our aging population, and millennials, our young generation, make it a no-brainer. Aside from the reasons that you see in front of you, you may want to think about how much longer the stock market will be on upswing. As good as it has been to us for quite some time, you may want to think about diversifying into more conservative commercial real estate. Even if you're on the fence while listening to me, you may want to pay attention to this guy. As with any investment, there are inherent risks. However, in a commercial real estate, they're easily mitigated. As you can see, investor risk is as negligible as it gets. Equity investors are not responsible for anything in a partnership joined by a syndication. By joining as limited partners, they limit their liability and they have no responsibilities or liabilities to a partnership whatsoever. One more small fact about the risks. It allows us to protect our family's future by creating additional, completely passive streams of income. In fact, I argue the opposite, that without diversification into commercial real estate, we risk diminishing our savings that we set up for a nest egg. Thank you very much for attending today's webinar. Just a reminder that you're welcome to browse the SAMO Financial website for more information about anything that you have heard in our presentation today, or to contact us at SAMO Financial if you have any additional questions. I will now hand the mic back to Brittany to cover the process of investing in syndications with the self-directed IRAs.
Thanks, Alina. I think I got it. All right. So now that we've talked a little bit more about commercial real estate investing and syndications in particular, as it relates to using an IRA for these investments, I just want to talk about specific restrictions. So we kind of covered the prohibited transactions and some examples earlier. So as it relates to real estate syndications, and Alina mentioned this as well, if you're using your IRA to invest, you can't personally be an active partner or a director or managing member of the entity that's going to be managing this project, right? So obviously if you were, you'd kind of be calling all the shots and personally benefiting from the investment in addition to your IRA. So the self-directed IRA can invest as a limited partner only, and that results in more of a passive investment. And then just remember that your earnings have to go back into the IRA if it's going to be the investor in order for you to keep those earnings tax advantaged. If you were to take those earnings personally and pay them directly to yourself, that would be a prohibited transaction. If you wanted to take them personally, you'd have to send them back first to your IRA and then take a distribution from your retirement plan. So just keep those things in mind if you're looking at doing an investment like this, but for the most part, you should have plenty of opportunity to set it up this way. Now, one thing we just want to touch on, and this doesn't apply in every case by any means, but it's important from an education standpoint that there are certain circumstances under which taxes can be incurred, even if you are using a retirement plan to invest. So the first example is situations where you're using your retirement plan as kind of like an operating company, and this wouldn't be the case with a syndication. But if you, for example, purchase or were leasing a business from someone like a car wash or a retail store in your IRA, and then you were operating it on a daily basis and you were making regular ordinary income, you would be expected to pay taxes as an operating company for that ordinary income because your competitors are doing so. So there was a case related to NYU years ago that kind of sparked this whole thing. So it's just important to understand that, like, sometimes this can happen if you're a real estate investor. It's usually not going to be the case unless you're doing tons of fix and flips in a year that seem as though you're doing no other business personally and you're just using your IRA to make income. So it's just important to understand it's called unrelated business taxable income. You can look at the IRS code, publication 598. And if you think that this is something that you want to consult with a tax advisor on, you can certainly do that as well. They should be able to tell you as far as rates that can apply, or if they think that this, that your investments would trigger UBTI. And then the second type is actually probably a little bit more common, and that's unrelated debt finance income tax. So this type of tax applies when the IRA leverages investments with debt. So this could be the IRA taking a mortgage, getting certain types of financing. If you're leveraging property in the IRA for a real estate investment, potentially there could be a tax associated with income that you're earning from that investment that's tied back to the debt you took on. So again, it's something that's not necessarily common, but it ties back to if the IRA is going to invest into an entity that's taking a loan to do a project, you just need to be aware of that. And that loan, as Alina mentioned, needs to be a non-recourse loan. And she's well aware of those requirements. But it's just important for you as the owner of the account to also understand that. And if it does happen to be that you owe some sort of tax, a 990T is the form that would need to be filed to the IRS, and then the IRA itself would actually have to pay those taxes, not you personally. So any cash that's in your IRA, would have to be responsible for those taxes. The good news, though, on a brighter note, and we touched on this earlier, is that if you have a solo 401k, again, reminder, if you're a business owner and you have a 401k plan that you establish for your business and you use that 401k plan to make these types of alternative investments, then these taxes don't apply to solo 401ks. So that's something that's important to note. If you're self-employed and you're not sure if you should open a solo 401k or if you should open a SEP IRA, you can certainly call us and talk to us further about your particular circumstances, and we can help you figure that out. So with that, I'm going to move on. If you wanted to actually do something like this from a logistical standpoint and a time frame standpoint, the first step would be to open an actual self-directed IRA. So you'd have to complete an application, fill out paperwork. The custodian would create a new retirement plan that would be in your name. You would get a new account number. That's very easy. Once the application is received, it's about 1 to 2 days. The second part is the part that can vary, and the reason why the 1 to 6 week time frame is there is because there are variables out of your control and our control, right? As far as anytime you're asking someone to move your funds away from them to somebody else, they're not going to be in a rush, and they're not going to be very excited about it. So whether you're doing a rollover from a 401k or you're transferring from an IRA, every custodian that's currently holding your account, which could be, for example, Fidelity, Schwab, Morgan Stanley, the list goes on. You guys know what some of these names are. They're going to all have different requirements as far as what they'll accept from us as a request. So we have to either, if you're doing an IRA transfer, we have to send them a request to transfer the funds. And sometimes they'll say you need a medallion guarantee on that form. Other times they may not, but just depending on what they need from you for security purposes, I'm sure as well. And as a financial institution, it could take some time to get the funds moved over into your self-directed IRA. But we've seen, this happen in as little as like 2 to 3 days. It's just that we want to be conservative so that if you're planning for a specific investment, you're not holding yourself to an unrealistic timeline. And then the third piece of it is, okay, your account's open, the cash has been moved into your self-directed IRA, you're ready to make investments. Okay, so what do? You figure out what you want to do, you do your due diligence on the investment itself. Ideally, you should know the prohibited transaction rules, right, because we've shared those with you. And you should figure out if this is something you can do, but if you're not sure, you can contact us and you can ask about it. And then when you decide you're ready to go, there's some documentation you'll complete and send in to us that we need to review, because every alternative investment is different. So this is not the same as clicking online to trade stocks, right? Because every single asset that your IRAs are holding are unique and different, and we need to take a look at them to make sure that they're named properly, that we're not seeing a risk of a prohibited transaction, and that as a custodian, it's something that's feasible to hold. So we know if you're investing into an LLC that it exists, for example. If you're buying a property, we want to know, we want to see the purchase contract for the property, for example. So there's an administrative review period associated with that for us, and we do that. That's very manual for us. There's no way to really automate it because, again, every investment's different. So just keep that in mind, that these accounts work a little bit differently. Somebody did ask about fees when they registered, and I just wanted to make sure we addressed it. You should expect to basically pay a setup fee to open your account, an annual custodial fee, which is going to be basically an administrative fee for us to handle and maintain the account. And then at the time that you decide to do a transaction, there are some transaction fees for purchasing an asset or selling an asset. So those are things that we're happy to share. We have a fee schedule. It's on our website, no secret. But if you do want to see it, oops, sorry about that. If you do want to see it, we're happy to share that with you. Sorry, I accidentally closed out my screen, so I'm going to take us back. And I'm going to talk about some of the specific investment documents that are required for doing something like this. So a set of internal documents we require you to complete, as well as supporting documentation for the investment. So on the left side, these are basically the documents that will be part of a packet we send you when you say, I'm ready to invest with my IRA. So the bi-direction letter is going to give us information regarding you as the account holder, additional contact information, which might be Alina's or somebody that you're investing with, and a description of the asset that you're purchasing, and that will be signed by you. And then the private placement instruction letter would include the name of the entity manager, the tax ID of the entity. It would outline the proper vesting and other important requirements for this investment, also signed by you. And then the advisory notice is going to be signed by the entity manager. So if you're investing into an LLC, we want to know the manager of that LLC understands and acknowledges an IRA's investing, and they understand the reporting requirements, and then that would be signed by a signatory of the entity. And then as far as sending the funds out from your IRA to this entity, you would tell us how you want us to do it. If you want us to send it by ACH, by wire, by check, you would instruct us to do that. We're a directed custodian, so we can't make those decisions for you. We can only do what you tell us to. So it's nice because it gives you more control, and we're not going to do anything with your money unless you tell us to do it. So then on the other side, the supporting documents would be things like the operating agreement for the entity that you're investing into, a certificate of good standing, a subscription agreement so we understand what your IRA is agreeing to, what actual terms it's agreeing to, and what return it's going to be receiving, and then private placement memorandum as well, if that applies. Our office also would sign these documents on behalf of your IRA. So you would actually mark them read and approved as the investor, and then we would actually sign them on behalf of your retirement plan. So they would have to come through us as the administrator to kind of review and approve and make sure everything's good to go, and then we would physically send the funds over for you. So just really quick, I know we're a little bit tight on time, but the capital flow as far as how the money would flow is up in the right-hand corner. You would be the account owner in this scenario. The custodian, the middle bubble, would be like a next generation, for example. Your plan, which is the green bubble, would be established, and then you would figure out what type of entity you want to invest into, whether it's a note you're buying, you want to actually purchase property directly, or you want to do a syndication, for example. You would contact us as the custodian and administrator. You would say, hey, I want you to send these funds from my plan into this entity, which we would do as long as we've reviewed and approved everything. And then once that yields a return, it's going to go directly back into your account so that all the investment earnings are, tax protected. You're not taking personal receipt of anything until you've decided you want to make a withdrawal out of your retirement plan. So in the case of a syndication, Alina can discuss in more detail, but most likely you're going to receive quarterly or monthly dividends and any principal payments, and then so those would flow directly back to your retirement account. So just real quick, if you want to connect or get more information, you can visit the website. You can call and speak immediately to a live representative at the office in New Jersey. You can physically come in, follow us on social media. We're on pretty much everything. We present at local meetups in New York, New Jersey, and Pennsylvania, and then we attend conferences in all states as well. We're going to be in Philly next month for a conference. And then we have, obviously, these webinars we do at least monthly, and then we have a weekly blog that we contribute to. So if you are looking for any information, there's a plethora of ways for you to get it. Hopefully this has been valuable for everybody. We're going to take a look at any questions that might have been entered while we were speaking, and we're going to try and address those. Okay, we got a couple actually. All right, the first question, the first question is, am I able to write my own check from my self-directed IRA if I'm doing a real estate investment? So the question is, the answer is, if you establish an IRA LLC, then yes, you can do that. So that's one of the things I briefly touched on when I talked about setting up a newly formed LLC that your IRA would own and invest into. So basically what you do is you'd have to consult with an attorney to set up your LLC's operating agreement, and it's not as simple as a regular one because you want to work with an attorney that understands ERISA law and knows that they need to include certain provisions in your operating agreement to say that an IRA is invested into this LLC, an IRA owns this LLC, and that they recognize what the prohibited transaction rules are and what it can and can't do. But once that's established, pretty much what you would do is you would work with us to say, I want to use my self-directed IRA to invest into this LLC that I created. And so we would send the funds, as long as pending review and everything is good, we would send the funds from your IRA into this newly formed LLC. On the operating agreement, your IRA would own it, but you could be the manager of that LLC. And so what that allows you to do is access the LLC's checking account, and so that's what gives you the checkbook control, right? So you'd set up a checking account in the name of the LLC, and you as the manager can then control those funds. So you can write checks, you can deposit checks, you can, have a debit card or whatever that you want to use to process transactions. So that's all great because it gives you the control, but again, you want to remember that this takes us out of the equation from a review standpoint. So we're not doing a compliance review then on everything that you decide to do with your LLC, but you still have to remember that your LLC is owned by your IRA, so it's still subject to all the same rules and regulations that the IRS is putting forth related to retirement plans. So don't get confused and think that it's your personal LLC. We have a list of best practices that we can share with anybody who wants it. So you can either enter into the chat box or ask another question, or just reach out to us after the webinar if you want that information. But we can tell you kind of the do's and don'ts when it comes to having an IRA LLC, because there can be a lot of benefit to having that checkbook control, but you just have to remember that there's a lot of risk that comes with it as well. And the better educated you are, the more you can mitigate that risk. Unfortunately, we just see the majority of prohibited transactions are coming out of those IRA LLCs. But checkbook control is something that we can certainly accommodate and that you can definitely have. So the next question, if my son is buying a fixer-upper to fix and flip and needs a hard money lender, is it possible for my IRA to be that hard money lender? Unfortunately, the answer is no. If we go back to the disqualified persons list, people disqualified from your IRA include your children, A sentence and D sentence, so your kids would definitely be a part of that. So if your son was going to own a property and then they wanted to take a loan from your IRA can't loan funds to your child. However, they would be able to take a loan from someone that's not related in that capacity. There are certain exceptions when it comes to disqualified people in the family tree. Some of those are cousins, aunts and uncles is another one. Certain in-laws are also exceptions. So we can provide additional information on that. Be able to directly lend to your son from your IRA to do anything, unfortunately. Okay, so another question was, can my significant other and I each invest some of our separate IRAs into a multifamily complex and manage it? If you would hire a property manager, understanding all income and expenses, flow to the IRA, and stay there until distribution. The answer is yes, as long as you're partnering according to the rules. So I'm not sure if your significant other and you are spouses, but if you're just, you maybe you're domestic partners or you've been in a relationship for a long time, it's probably safer to just look at yourselves as spouses, but okay, you're not spouses. Thank you for responding. Even so, I would just be careful about that, and I would kind of try to look at yourselves as disqualified individuals. That doesn't necessarily mean that you can't do this investment. What it means that you can, if you each have your own IRAs, you can partner into the purchase of a multifamily complex. The additional level of regulation and restriction, though, to be aware of is that since your IRAs are basically just potentially disqualified from each other, meaning that you can commingle funds. If you look at this as if you picture in your mind like two parallel streams of funding going into a property, you can do it that way. So you would have to, though, determine up front how much is each IRA going to own. So what are the percentages of ownership of each IRA when it comes to this project? And then make sure that those percentages of ownership from the initial funding until the end of the project are consistent. So let's say you're going to do it 50-50, just for simplicity's sake. You would go into the property 50-50. Both of the IRAs' names would be on the deed, on the purchase contract. Both IRAs would, contribute their deposit. Any payments of any sort would be split 50-50. Any payments required to manage that property or that project. And then the same would be for any income that would flow back from that project. So if you're, selling the property, or if you're going to rent it out and just take in rental income, it would have to be split 50-50 so that you're not altering each other's ownership percentages. And then a follow-up question was, would it be best to form an LLC owned by the two IRAs? That's a good question. Maybe administratively it might be. So administratively, what you could do is you could form a new LLC, and you could have each IRA invest into it as members. And then once that happens, the LLC is kind of just managing, you could both be managers of the LLC, so you could write checks or do whatever you want to do with, not necessarily whatever you want to do, but within regulation, you could manage the funds that way. And then where the percentages and the ownership distinctions again come into play is when you're ready to send funds out of the LLC. So if you're sending funds out of the LLC back into your individual IRAs, that's where it's still, again, going to have to be split per your original percentages of funding. And it also means that if you initially funded that LLC 50-50, every single time that somebody decides they want to put more funding into the LLC, it has to be balanced out. So if one IRA wants to put in, $50,000, then the other one's going to have to put in its equal share in order for that IRA LLC to be owned 50-50 by both. So you just have to keep that in mind. And it's not too bad, but you just have to think about, okay, how much buying power do we each have? How much do we think we're going to need for our projects? How can we fund these IRAs? Do we have multiple sources of retirement plans that we can use to either roll over or transfer? And we have to respect that, we have to be consistent in terms of percentages of ownership. Okay, so I know we're kind of running over time, but we got another question. Do you have any detailed information that you can send out on non-recourse loans and how they work? So we can send some basic information about non-recourse loans. Alina, you might even be able to touch on your experience with non-recourse loans if you've had to take them in any of the projects that you've worked on. From a custodian perspective, because we're not advisors, we know of some lenders and banks that will consider non-recourse loans, and we can share that information with you. So if you wanted to do some due diligence and reach out to them, it would be up to them to determine whether they'd grant you a non-recourse loan. And again, a non-recourse loan, just to recap, is just a loan that would restrict the lender's recourse to the property in question. So typically if you're taking a loan, like you're, providing a personal guarantee or you're extending credit to some other assets, right? In this case, if an IRA is leveraging property to protect the IRA because it's a retirement plan and its assets, we're saying the lender, if you default on your loan, the lender can't take anything but the property. So they could only foreclose on it, and there's nothing else that they can take from your IRA or you personally. So it's kind of a protection device, but at the same time, it can limit you as far as getting financing if you need it when an IRA or a self-directed plan is involved. So that is important to know. These are not overnight decisions. For anyone who's new to this, if you feel like you're overwhelmed right now, don't worry, because it's normal to feel that way. There's a lot to take in, and the more research that you do and the more education you get for yourself, the better equipped you'll be to just be successful with doing something like this. And we're happy to connect people with others who've done these types of investments. If you want a perspective from someone who's lived it and can maybe give you their opinion, we're happy to connect you as well. So with that, I think that covers all the questions that we have. Thank you for the compliment from someone who said great job. We appreciate that, and we appreciate everyone being patient to stay on for so long. Alina, do you have any closing comments or anything else that you'd like to share before we adjourn tonight?
Brittany, just to reinforce what you said, the non-recourse loans are not allowed for self-directed IRAs. I mean, the other tools that are used within syndications, but by the general partners, the general if necessary, but the preferred option would be, of course, having the recourse loan. But yeah, from self-directed IRA perspective, they're not allowed, period. Other than that, that's all I have. Thank you very much. I hope our audience enjoyed tonight's presentation. And again, if they have any questions, they can feel free to reach out afterwards.
Great. Thanks, Alina. We appreciate you sharing your expertise. We're going to end it for tonight, and everybody will receive an email with a copy of the recording as well as a survey. If you could provide some feedback, we'd really appreciate it. Thanks, everybody. Enjoy your Thursday. Have a great night.